Welcome back to Morning Markets on Monday, the 11th of October. Looking first at markets on Friday, the 8th, looking at equity markets in sterling terms. In the UK, the FTSE 100 was up 0.25%. In the US, the S&P 500 down 20 basis points, the Nasdaq down 50 basis points. Europe was off around 60 basis points. Asia, outside of Japan, was up 26 basis points, and Japan up 1.34% on the day. Global equities over the week were up 1.6%. Energy and financials are stronger performance sectors, with utilities and healthcare lagging. Chinese markets were closed through to Friday for the Golden Week holidays, but advanced 1.3% on Friday, with strong PMI service readings and signs that action had been taken in Beijing to increase coal output to tackle the nationwide power crunch, which has been limiting industrial production in certain regions. In terms of bond markets on Friday, UK 10-year gilt yields were at 1.16%, so up 8 basis points on the day. US 10-year Treasury yields were at 1.61%, so up 4 basis points on the day. Global government bonds produced a negative return over the week given that rise in yields which we experienced. Yields moved by 15 basis points in UK gilts, 13 basis points in US Treasuries, and around 6 basis points in European bonds, German bonds being the proxy used there. Corporate bonds also lagging behind as well. Higher yields provide a proxy for company financing costs. Therefore, this move also fed through into valuation models in equities, hence some of the volatility which was experienced there. The dollar was slightly weaker on the day, so the Dixie was at 94.1, down 16 basis points. Sterling against the dollar was at 136 sterling, against the euro at 118. So the dollar was around 32 basis points stronger over the week relative to a basket of international currencies. In terms of commodity markets, oil, so Brent crude, was at $82.5 per barrel by the end of the week, so up around 1.4%. Gold was up 11 basis points. Energy prices were one area of focus last week, with a spike in natural gas prices feeding into the mid part of the week, but starting to ease towards the end of the week after suggestions that Russia could increase supply into Europe. Oil prices, as I say, were up 1.4% over the week, reflecting demand dynamics, along with the decision by OPEC Plus not to increase supply levels further, which would have been supportive for lower prices. A lot of the moves, especially within the bond market last week, reflecting the increased focus on inflation, the need for a resolution or an extension on the debt ceiling in the US. However, the debt ceiling pressures did start to alleviate on Thursday following the Senate vote for a temporary extension. We also received a number of data points highlighting the health of the US labour market. Non-farm payrolls grew by 194,000 in September, but that missed expectations, which were some 500,000. The workforce participation rate also ticked lower, which some viewed as especially surprising given the pandemic unemployment benefits drew to a close. The unemployment rate fell to 4.8% in September from 5.2% the previous month. Average hourly earnings rose were also some 0.6% higher. Weekly jobless claims reported Thursday fell slightly more than anticipated. This week we'll receive the minutes from the September Fed FOMC meeting, which will add context behind the expectation of central bankers at this point as analysts look for a change in the language or the emphasis in projections, along with the expectations for inflation and employment as we move forward, especially ahead of the November meeting where markets are anticipating a policy taper announcement. Thank you very much for watching. We look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.